Welcome to Beyond Just Money with me, Samta, and today I have with me Ms. Nidhi Sinha, who is the head of content with Calcine Media. Now, the rising bond yields are often the cause of panic among investors who have vested interest in the equity market. US Treasury yields are used as benchmark across nations and influence prices in every sphere of financial sector. With a spike in the Treasury yields, it is an alarm bell for equity investors as it prompts higher investments in the bond market against the withdrawal from the stock market. So Nidhi, what do rising bond yields indicate about the economy?
Thanks for having me, Samta. Yes, 2021 has seen varying episodes of, bond yields spike. So before I answer your question, it is also imperative to understand the factors that determine the bond yield scenario. Bond yields are basically determined by dividing the annual coupon rate by the current market price of the bond. Thus, there is an inverse relationship between the price of the bond and the interest rates. Simply put, bond yields represent the returns received on a bond. Due to the inverse relationship between prices and interest rates movement, monetary policies often end up impacting the bond market. Generally, record low interest rates are implemented by central banks to encourage spending and investment in the economy. However, this causes the bond prices to soar and yields to fall. At the same time, several other factors impact bond yields, such as economic growth and inflation expectations.
Right, Nidhi. So is rising bond yield a matter of concern?
Absolutely, it is a matter of concern. The effect of surging bond yields on individual pocketbooks can also be seen through the property market. This happens as interest rates charged on fixed rate loans tend to shadow the movements observed in the treasury yields. At the same time, savers could start to see a rise in rates in their high yield savings account. Like commodities, bond prices are also highly receptive to changes in the demand and supply for investment money. Higher rates attract more buyers to the bond market, which drives bond prices up and ultimately rates back down. Some of the other major causal factors behind the surge in bond yields can be the expectations of economic expansion and the associated inflation that comes along with it.
Okay, so can you tell our listeners how bond yields are impacted and how this impact is forwarded to the rest of the market?
That's a very relevant question. Actually, interest rate moves in the same direction as the bond yields. However, the underlying mechanism involves several stages. As interest rates are increased, the new bonds issued have a higher yield associated with them due to this rise. However, pre-existing bonds lose their value in the market. I'll give you an example. So if bond A offers a higher yield tomorrow than bond B today, then the prices for bond B must adjust to make the coupon payments equal and make both bonds equally attractive. If the price adjustment doesn't take place, then most investors would, prefer going for bond A because it is offering a higher yield. For bonds belonging to a similar category, coupon payments must adjust to remain the same. This leads to price changes in bonds offering different yields. Under inflationary pressures, investors usually turn to the bond markets instead of the equity markets. Expectations of a price increase can lead to bond prices falling with a corresponding rise in yield. Rising prices then erode the potential returns that are offered on a bond. As nominal interest remains the same and inflation rises, the real rate declines. When inflation is on its way up in a country, investors tend to expect higher returns on the bonds to make up for the losses in purchasing power caused by inflation. To put it simply, the existing inflation causes a triggering effect on people's expectations for the future inflation level. Inflation also affects bond yields indirectly by urging a response from the central banks in the form of expansionary monetary policy. This is basically done to reduce the short-term demand for credit. This short-run increase ends up, affecting the intermediate and long-run rates in the market. Consequently, bond prices fall and bond yields rise.
Talking about bond yields, Nidhi, what is its impact on other assets?
Well, given that long bond yield represents the risk-free rate, a higher bond yield is generally bad for equities. While high yields can paint a negative scenario for equity markets, the cause for the hike in yields must also be examined before jumping to any conclusions. This is so because yields rise with inflation as well as with high economic growth, but both these scenarios have a different impact on the stock market. Inflation-induced yield hike would most likely encourage investors to move from equity to bonds. However, a yield surge caused by economic growth can be a good sign for the equity market as well. When the growth is strong, dividends more than offset the negative impact which is caused by rising yields on the stock market, which in turn induces a surge in share prices.
And how do bond deals affect the economy?
Well, bond yields is a critical fundamental factor to determine the performance of the economy as well as the equity markets. Bonds are considered less risky when compared with equity investments. Normally, stocks tend to perform well in the case of growing economies. However, equity markets move negative with rising bond yield in the long term. Moreover, a higher risk appetite would encourage investors to buy equities rather than bonds. In the case of declining economies, on the other hand, investors prefer purchasing bonds as they would desire fixed returns for stability. The rise in bond yields would increase the cost of capital for companies, which would reduce the valuation. Thus, stock markets across the world would be adversely impacted by increasing bond yields. Typically, central banks allow yields to go up when they anticipate signs of accelerated economic recovery. For instance, the US Treasury yield rose on 19th May 2021 as the latest released Federal Reserve meeting minutes indicated that the central bank might taper the bond purchase if the US economy continues to recover at the current pace.
Absolutely, Nidhi. It will be interesting to see how it goes. Thank you so much for coming on the show today.
Thanks, Samta, for having me on the show.
Well, to all our listeners who want to listen to this podcast again, please log on to our website, that is 𝐊𝐼nmedia.com, or you could also go to our YouTube channel. Please don't forget to like, share, and subscribe, and hit that bell icon for notification on the latest videos and the podcast. Until we see you next with yet another insightful episode of Beyond Just Money, stay safe and stay apprised and invest wise with 𝐊𝐼nmedia.